Middle market companies can be the backbone of economies, but are often overlooked for their larger or smaller counterparts. Joining me down the line is Tom Stewart to explain why this shouldn't be the case. Tom, you say that a competitive US is created by and depends on the companies of the middle market, mid-size outfits that have had outsized impact on the nation's prosperity and success. Why do you say that?
We're the only group devoted to studying the U.S. middle market. Now, we define that as the middle third of the private sector, which means companies with revenues between $10 million and $1 billion a year. It's two orders of magnitude, but they're bigger than small, they're smaller than big, and it's the middle third of private sector GDP and employment. And when I say it's crucial, it's because this is where the growth is. Last year, middle market companies grew at more than twice the rate of the large companies in the S&P 500 and more than twice the rate of the smaller companies with revenues of less than 10 billion. The same is true of payroll. They added jobs at a 5% rate. Big companies added jobs at a 2.2% rate. Smaller companies added jobs also at a 2.2% rate. This is an unknown story, but the fact is, if you're looking for the growth plate of the US economy, and by the way, it's true in most developed economies, the mid-sized company is where you find it.
Well, if this is where the growth is, why are they relatively ignored then by policymakers?
85% of the middle market is private. So there are no stock market stories. There are no, there's sort of the daily obligato of business news of who's up and who's down is rarely heard in the middle market. Within those, about a third of that 85% are family businesses, and some of them are private in more ways than one. They just don't seek the limelight. The middle market companies, even those that are well-known brand names, they don't sell newspapers, they don't sell magazines. You don't sell more copies of Fortune magazine by putting the CEO of Tootsie Roll or Elmer's Glue or Weber Grills or Nathan's Hot Dogs or any number of other well-known middle market companies. So they're forgotten in that sense. And there's also a cultural sense, at least in the United States. There are two great stories that we love culturally. One is the story of the captain of industry, the buccaneer, the J.P. Morgan, whoever she or he might be. And the other is the story of Steve and Woz in the garage. It's of the startup. It's of the guy who maxes out his credit card and then his wife's credit card and then his mother-in-law's credit card before finally the tide turns like the Bay of Fundy and the next thing you know, he's a billionaire, a Silicon Valley billionaire. Those two cultural myths or cultural stories, types, play very well in the United States, but the middle brow, middle class, middle market, that story doesn't resonate in our cultures.
Mid-sized companies, though, are normally startups that have grown slightly and are entering a period of maturity that normally leads to stagnation and decline. Would you say that's right?
There are some who are startups and are going through what you might call their adolescence before they enter their middle age or their maturity. But a lot of them, if their median age is 31, as I said, their growth is very strong. But it's unfair to say that they're startups sort of racing through a period of their lives. Many of them have been there for some time.
But surely mid-size is something no company aspires to be. All companies of this size either invest to grow more sizable or trim to be more lean. Wouldn't you agree with that?
In many cases, yes. Although if you look at some of these, particularly some of these family businesses, they're what we sometimes call lifestyle businesses, in which the company wants to be the right size, whatever the right size is. Hugely resist the temptation to become too big. They think it makes it hard to be nimble, hard to be profitable. We've seen a decline in the United States in the small business IPO, the initial public offering. And as I said, 85% of these companies are private, so they're not necessarily wanting to go public for the big payday to make it in. They're wanting to run a great company.
As you pointed out, they do represent a large portion of the US economy. Isn't that somewhat uneconomical?
As you get up to that high level, that level of $2, $3, $4, $5 billion worth of sales, growth becomes harder and productivity, cost control becomes more important. Big companies tend to create a kind of sclerosis, a kind of growth of administrative barnacles that frequently need to be scraped off with restructuring. And it's one of the reasons that consulting firms do so well, is that they need to help large companies sort of clean themselves up and often shrink themselves a little bit so that they can regain some efficiencies. So the premise that economies of scale are unlimited is just not right.
So mid-sized companies drive a lot of economic growth. Can you see this being a long-term thing? Where are these companies going?
They have different fates. Many of them are sole proprietorships or family businesses. There's a datum that goes something like 60% of all the owners or the runners of a family business hope and expect to pass it on to their heirs, but only something like 35% do. So in many cases in a family business, there's no succession and something has to happen. That's often an opportunity for private equity. And one of the interesting dynamics that you see in the middle market is a whole number of private equity firms that specialize in middle market firms, often at some sort of leadership transition, where private equity companies come in, make some new investments, and private equity in the middle market tends to be very much an investing, not an asset stripping kind of activity. Make some new investments and then sell it or set it up on its own independently again.
So finally, if policymakers did sit up and take more notice of this sector, what sort of things would you like changed, and what kind of impact do you think this would have on the US economy?
We have friends at the Brookings Institute who once asked economic development people where they spend most of their time. The number one use of time was trying to lure a big Fortune 500 company investment, getting a company to move from California to Texas or Texas to California, or getting a greenfield investment from a European multinational, for example. Second biggest use of their time is with startups and incubators and trying to attract that kind of the next Silicon Valley activity. And the third biggest use of their time is trying to help companies grow that are already there. And yet, if you look at job creation, the order is exactly reversed. So attention is not being paid. Where should it be paid? First is in some of the needs about that we have nationally and middle market companies have about infrastructure. Infrastructure is their number one concern. Some of it is roads, bridges, tunnels, all highways, ports, all that good stuff. Some of it is also cyber infrastructure and development of the sort of the IT infrastructure nationally and globally. Second big issue for them is workforce. A third is a sort of what you might call regulatory equality. In this country, small business is frequently exempt from certain regulations. Businesses below a certain size don't have to comply with X, Y, or Z. And large companies often are able to carve out their own exemptions through lobbying power or have enough scale that they can overcome the problems. The mid-sized company is sort of stuck in the middle. Impact? One of the things we should point out is that these companies are already dramatically outperforming both big companies and small companies. So if the regulatory and infrastructure and sort of business environment can be improved for them, I expect that we'll see them outperforming even more.